this is, some good economic news. I was just telling you that the housing bubble did not come to pass, not yet. A high demand is keeping prices high. Prices have only decreased 1.2%. A lot of folks thought there would be a housing bubble burst in 2023, but it hasn't happened. Joining me now, Nick Hopwood, certified financial planner, founder and president of Peak Wealth. Peak Wealth. Nick, good to see you again.
Thank you, Steve, and I hope you had a wonderful 4th of July, all your viewers and listeners as well. And hey, if I can't be up north at Lake Charlevoix this week, I'm happy to be here with you.
Well, I appreciate that. No, it's a good place to be. Anyhow, the market has been strong, stronger than expected, double-digit returns. And so you told me, historically speaking, when the first half of the year is strong, as this one has been, the second half median return is 10%. It's positive 82% of the time. In all years, the second half of the year return is 5%. So we're setting up for maybe double the average. Could be a good second part of the year is what you're telling me.
Yeah, and a lot of people are looking at the market very surprised with the strong first half and thinking, well, it's time for a breather, and it may be, but I would be a buyer on any weakness here. As you mentioned, when the first half is this strong, the second half median return is 10%, positive 82% of the time. So history is looking good as far as the second half right now.
So you've got that going for you, but I still see rate increase. I was talking to a guy, I mentioned this just a few minutes ago on the program. I'm talking to a guy that sells boats, and the best rates they can get for people with really good credit is over 11%. So boat sales, flat. Things that involve interest rates, pretty flat. Housing, staying strong. Demand is high, so prices remain high as the inventory is low. Where do you see this opportunity? I mean, there's got to be places where you can put money. I'm not sure those are the places. Where would you put it?
Well, the tech rally has really been strong the first half of the year, leading the market, and they are stretched. The PE valuations on the big tech is over 30, so that's extremely high relative to history. And that means that the rest of the market is trading at much better of a discount. So the PE ratio of the overall S&P is about 19, which is above average. But if you take out tech, the rest of the S&P has a average PE of 16, which is right on the historical average. So there are opportunities elsewhere, including international and small caps. And in fact, real estate, a lot of these traded REITs are down 30% as well. Is it justified? Perhaps. But are there opportunities? There will be.
So when you talk about a REIT, tell the folks what you mean. It's a real estate investment platform. It's different than just getting into a mutual fund, obviously, but explain it, please.
Yeah, REIT stands for Real Estate Investment Trust, and it's a hybrid investment, meaning you have a nice dividend, which is the flow through of rent, and you also have the appreciation. Typically, real estate tracks inflation. So if you have multifamily housing, commercial, offices, industrial, and they're all down 30%, well, that might make sense with offices. You know very well, with offices in San Francisco and New York, they have a lot of trouble. But in other sectors, it's not necessarily the same setup. So if they're all down 30%, there could be opportunities.
Yeah. Commercial real estate. I feel sorry. I do in some regards. People have commercial real estate because people went home for the pandemic and they never came back to the office. And I know several people that said, yeah, we're dumping our office because why would we keep it, right? Why would we keep it? Because they don't have the people to come in. Why would we keep that overhead, all that expense? So they're dumping out, either getting rid of the office altogether or going to something much, much smaller. And yet, where I live here, in southern Michigan, I drive through areas that have all these office parks, and I've called on a couple things. They have not changed their price. They still think it's 2018 or 19. Apparently, they're okay with sitting with unit after unit after unit just being empty. Strange to me. What do you say about it?
Well, I appreciate the anecdotal story, and I think the prices would have to come down if they're sitting vacant for that long. But one thing that I'm noticing in the economy right now, everyone's calling for that recession. Everyone's calling for the housing crisis, housing crash, but it's just not coming through to fruition. And so we have this discrepancy between hard data and soft data. A lot of the soft data is negative is awful, frankly. And that's driving the leading economic indicators to be negative for 14 months in a row. And that's a record. So that would definitely suggest we're in a recession or a recession is coming, but the hard data does not suggest that at all. In fact, we have GDP growth around 2%, stock market up double digits year to date. So the hard data is telling a different story. So, this divergence is going to have to be worked out some way, somehow soon, whether we do fall into a recession or whether, the economy follows the market higher.
Yeah. So complicated, but we get back to work on Wall Street today, don't we? We go back to work and we see where it goes. Oil is soft. Gas prices are, better than they have been. Not as good as they were when this administration took office, but not bad. The real problem for consumers is, a cumulative inflation of over 15% on groceries and so forth, because the inflation is cumulative. Those are some of the big challenges. I'll give you the last word here, Nick.
Yeah, it is the cumulative effect of inflation, and like you said, it is coming down. The CPI is at 3%, the core is at 5%, but it's much higher than it was 3 years ago, and that's really the key. And that's how, when we walk in the grocery store, we feel that more than anything.
Yeah, food is the one I think that pinches people the most. Tell people how they can find you, Nick, and have a conversation about finances in the future.
Yeah, thank you, Steve. You can put our 25 years of experience to work for you. Check us out at peakwm.com.
Peakwm.com. Nick Hopwood. Always appreciate you being here, sir. We'll talk to you soon.
Thank you, Steve.
There you have it. It is the food that I think is the most. It's the thing that I see the most that makes you go, wow, is it really that expensive? And the answer is, yeah, it is. Thanks, Joe. You did that. I'll take a break and be back.